Hello, everyone, and welcome to the ninth edition of Finding Our Freedom. Finding Our Freedom is about the positive political and socio-economic change that we need to see in the Caribbean and how to make it happen. We aim to transform how Caribbean people understand the challenges in this region and empower everyone with actionable solutions to drive real change in our communities and our countries. Freedom comes from self sufficiency, so we will also be exploring the ways in which we as Caribbean people can secure greater levels of freedom via strengthening our self sufficiency on an individual and on a collective level. Freedoms also require and depend on everyone taking responsibility. So, we will explore the ways in which we as Caribbean people can live more responsibly, can hold our leaders to account for delivering on their responsibilities as well. On this episode of Finding Our Freedom, we explore the Caribbean's credit risks. What exactly is credit risk, and how and why do we measure it, and why is it important? Risk is everywhere around us, especially now. But I guess most people don't think about risk in their day to day lives. But to my mind, it's like blood pressure. You don't notice it, but if you don't measure it and monitor it, you could be having serious problems that go undetected. And here with me today to discuss the whole issue of credit risk is the CEO of CariCRIS, the Caribbean's leading credit rating agency, to talk all about Caribbean credit risks and ratings, what's the meaning of risk, and why is it important to us. Dereck, welcome to Finding Our Freedom.
Marla, thank you for having me.
Dereck, before we go into the questions that I have for you, because we have a lot of questions, I want you to just introduce yourself, tell us about what you do as a risk professional, um, and what drives you to do this kind of work, because it's a very specialized kind of work that you do.
Yeah, thanks for that, Marla. So just a very brief background. I worked in the financial sector for many, many years, over 20 years, most of that in leadership positions. I most recently, in the last couple of years, joined CariCRIS, moving from the financial sector into this sort of specialized aspect of the financial sector. At CariCRIS, my role and my goal is to really drive ratings in the Caribbean, make it more widely accepted, make it part of the DNA of our regional financial markets. So my goal is to continue expanding the use of ratings, expanding the education around ratings, and conversations like this really do help, driving that education. So I really appreciate the opportunity to speak on this today.
And I'm appreciative that you're here because risk is something I think a lot about, even if we may not identify it as risk that we're thinking about. I think everybody thinks about risks. When we think about, should I buy a new car? We are thinking about the risk of buying the new car, the risk to us financially, primarily, and also the safety issues around the car itself. So I think most people, we think about risk in many different ways, but we don't necessarily recognize that it's risk that we're thinking about. And so that's why I think it's important for us to have this kind of conversation and define these risks. So tell us, so CariCRIS really specializes in looking at credit risk, which is a very specific type of risk. We have all different types of risks. You can talk a little bit about the different types, but tell us exactly what does a credit risk mean, and also tell us what it doesn't mean.
So you asked early on, like, what do risk professionals do, right? So what we do is really assess information that can help us come to conclusions about the level of risk that we're taking. And as you rightly said, there are different kinds of risk. Credit is one aspect. There's another risk that's a bit more specific to the investment world, which is your market risk. Then there's risks that are more broad and general, like operational risk, where you think about things like people and process and systems and so on.
Mhm.
So there are many different categories of risk. Those are some of the big, broad ones. And straight to this point, credit risk is really the assessment of, it could be a person, a company, or a country, their ability or capacity to pay, as well as their willingness to pay any debts that they have undertaken. And you draw a good example from day to day life. So if I were to draw another one, we all, at some point in time or the other, have taken a facility from a bank or a financial institution.
Meaning, when you
And
say
you'd know,
facility, meaning like a credit
like a
card or
loan, yeah,
like a
you'll
loan,
take
a
a loan,
mortgage, or a car loan.
a loan
Yes.
to buy that car that you mentioned before. You'll take your car loan or your mortgage on your house or a student loan for your kids or whatever.
Mm-hmm.
And you know, if you go to the bank, they ask you for some specific things, right? They ask you for
Yes.
your income, they ask you for your
Mm-hmm.
expenses, they ask you about what other debts you have, and things like that.
Mm-hmm.
And the other thing that they do is they check what we call the credit bureau score. Some people know about it, but it's something that the banks have access to. And that is really meant to identify the two things I mentioned. So your salary, your expenses, your other debts influence your capacity or ability to pay the loan that you're going for, right?
To honor
That's
your
different.
debts. Yes.
That's the
Mm-hmm.
ability. That means I have the excess cash to pay this monthly loan payment without
Mm-hmm.
seriously impacting my life.
Mm-hmm.
The credit bureau report, that's a specific report that shows your history. How have I paid my past loans or current loans that I have? How have I paid my credit card, etc.? Those things show up on your credit bureau report. And you use
So
that to
this is like your
gauge.
credit rating, like in the US, you
It's
talk
like
about
for an
your
individual, yeah, like,
credit score. Yes.
there's a
Mm-hmm.
credit score attached to that.
Mm-hmm.
So if you have a high score, it means that historically you've paid your facilities or your loans or your credit cards on time. And that
Mm-hmm.
gives the bank the willingness aspect of it. So you have the financial or quantitative side, which gives you the ability. I have the cash, I can pay. And the credit bureau report and the credit score says, well, look, historically, this person has paid well. So there's a high likelihood that they will continue to pay new facilities.
Mm-hmm.
So that's sort of how you could gauge what we do on an individual level. We do that same thing for companies and countries. We don't deal with individuals, right?
Right.
We're a credit rating agency, not a credit bureau. So we do that exact same assessment of ability to pay using quantitative type metrics, as well as willingness to pay using qualitative type metrics. And we could get into some of that in the discussion.
Especially as it relates to countries, because of course that's where I feel, well, first of all, where I pay most attention to, but where I feel um, it affects most of our lives in ways that we probably don't necessarily recognize. I mean, yes, you do company risk ratings, but when you think about, and I'm sure the average person would have heard in the past a particular country getting upgraded or downgraded. And no, it's not upgraded to business class. What does it mean when you have a country credit risk rating? And and also, what does it not mean? So explain that from a country perspective for us.
Right. So first, let me just clarify what a rating is and is not, because that's, you mentioned an
Yes.
important point there. What does it not mean? Because
Mm-hmm.
there's some conclusions that people make about ratings that may not
Misconceptions.
necessarily
Yes.
be true.
Mm-hmm. Mm-hmm.
So fundamentally, a credit rating or any credit assessment is really an opinion. It is not fact, right? So it
Mm.
is an opinion. It's a well researched. It's rigorous. It's based in methodologies that have been developed and tested over time. So
Mm-hmm.
it's for an agency, it's our best opinion of the credit worthiness, i.e., the ability and willingness to pay based on the information that we have seen. So
And I
it's
just
not a
want to
guarantee.
exactly. I just want to stick a pin and pause, and sorry to cut you there, but it's no different from a lawyer. When you ask a lawyer for an opinion on a particular, how should I behave in this particular circumstance, and a lawyer will give you an opinion. So it is an opinion. It is your best judgment based on all the information you have available to you.
Yeah, that is correct. And there's always probabilities that those things will not work out, right? So we typically see that for very highly rated companies or countries, the probability of them not being able to pay their debt or defaulting on that is usually very low.
Low, yes.
But low meaning that it's not 100%, right? So it will probably
Yes.
be 90 something percent, but there's always that small chance that something
Things
extraordinary
don't
happens
work
that
out
could.
quite the way they
Exactly.
expected to work out. Yes.
So we always like to make sure people are aware that this is an opinion, it's not a guarantee, it's our best assessment. And similarly, it's just like your credit score from the credit bureau. These guys look at history and say, okay, most likely you will be able to pay going forward, but something may happen in your life that
Changes those
creates
circumstances. Yep.
creates a disruption for you.
Mm-hmm.
And what it's not a recommendation to buy, sell, or invest in anything, right?
Mm-hmm.
Again, for investment purposes, we like to say the credit rating or any credit assessment is a tool. It's one tool, it's one factor that you should consider because our
Mm-hmm.
reports and our ratings give information that would be useful in your process. But as you know, investing is not just about the risk of the investments, it's also about your own personal risk appetite. It's also about if you're a company, you may have policies around what you can invest in and so on. So the credit rating is not the only tool, but it's one tool that you should use and could use in your investment. So it's not a recommendation to buy, sell, or invest because we don't know the personal or the situation of the particular company that's using this information.
Right.
Some people tend to find that ratings could come across as a criticism, especially if it's not where you expect it to be or if there's some negative aspect of the report. But it's not meant to
Right.
be that way. We're going in very unbiased. And what we want to do is to tell you very objectively where your credit rating stands and what you can do to help improve it as well as to prevent it from declining. Right. So,
Right.
some people could take it as a bit of, well, the rating agency put this negative thing, but it's not meant to
Mm-hmm.
be that, right? It's really an unbiased opinion. And the third thing I'd mention, what it's not permanent, right? Rating is a point in
Mm,
time thing.
that's
Because
important.
even in our personal lives, we could be in a very good situation today and some unexpected event comes up and we may have to divert resources. Same thing
And
happens with countries, with
with
companies,
countries. Mm-hmm.
right? We could see, like in the Caribbean, we exposed to hurricanes. If things could be going very well, and the hurricane impacts the country, and then you have to reprioritize how you do your business. So it's
Yes.
not permanent. It's based on the information at the time the assessment was done. How we bridge the gap is that we have a process called surveillance, where once the rating is completed and accepted, we do keep in touch with whether it's the country or the company. We do keep in touch with them so that we're always following up on things that are going on. We always keeping track of news and events that may impact them, and we'll talk to them about it. They would have to periodically confirm to us that all their debts have been paid. They'll have to
Mm-hmm.
periodically give us updated financial information. And then, assuming that nothing untoward happens during the year, we go through a full evaluation process at the end of every year. So all
Right.
ratings that are public and that are accepted go through what we call an annual review process, where at the end of the year, we go back through the same process and evaluate the rating again and take into account things that may have changed with the country or company, whether it's improvements or negative things that would have happened, and that gets captured. And that's where the things like upgrades and downgrades, when you hear of an upgrade, it usually means that as part of their review process, the rating agency has identified that this company or country has improved so much that their credit is now better than it was last year. Their
So their
credit
credit
profile is
score,
better.
basically. Yes, the credit
So
profile.
in
Yes.
in individual terms, their credit score.
Mm-hmm.
has improved, and therefore they would get an upgrade either in their outlook or in their actual rate. And we'll talk about the difference between those two a bit later. But that's where upgrades happen. Upgrades typically mean things are going well, they're achieving the things that we would have identified for them in the reports that could lead to an upgrade. And similarly, for downgrade, it means that things are not going so well and there are certain things that are weakening that leads us to believe that look, your overall capacity and to pay debt is declining. So that's where
Yeah.
the upgrades and downgrades come in.
Right, which are things that these are newsworthy events, and usually we get, news and all kinds of commentary whenever there's upgrade and downgrade. But before we get into how the specifics of those, give me an example of some of the countries that you currently rate.
Yeah, so to be honest, in the Caribbean, we tend to keep an eye on many countries, even if we
Right.
don't have a formal rating relationship with them. But we formally rate a few countries like government of Trinidad and Tobago, government of Barbados, uh, Dominica. So those are examples of some of the countries that we rate. But we do have companies in almost all the major countries in the region. We have companies that we rate from Belize up north, come straight down to Suriname down south. So
Right.
even if we don't have a formal rating relationship with a country, and we're trying to pursue formal rating relationships with all the countries,
Yep.
but to rate a country, to rate a company, we must understand the country first, right?
The
So we
country.
have
So you
some
kind of have to
formally,
rate the country
yeah. So
informally
so we
first.
have to do
Yes.
some kind of internal assessment of the
Mm-hmm.
country in order to
Mm-hmm.
rate the companies within that country, which is one of the things we'll talk about in the challenges where we are trying to get governments to understand that even if you don't need a rating from CariCRIS for yourself because your intentions are more international financing, your CariCRIS rating helps your local players who may not
Right.
need or be able to access an international rating.
So you have a rating scale um, that the viewers will be able to see on the screen, where it goes from a regional, national scale, and the definition. So you have your long-term rating scale, CARI AAA, so triple A, um, and that's a national rating of triple A, all the way down to CARI D, and D meaning default, meaning
Yes,
you're not willing or able to pay your debts.
correct,
Whereas with AAA means you have the highest capacity in your assessment of being able and willing to honor your debts as a country or a company.
correct.
Yes?
Yes, so just one point of clarity on the
Mm-hmm.
table. There's a national and carry scale side by side, but it's not equivalent, right? It's just how CariCRIS operates because we are the Caribbean's rating agency, and we
Mm-hmm.
rate the entities in this region on either a regional scale or on a
Mm-hmm.
national scale, right?
Okay.
Or both, right? Because some if so
Mm-hmm.
for example, if you operate in Trinidad and Tobago, you can get a carry scale rating, which compares your rating against other similar types of companies in your industry in the wider region.
Right.
And you can have a national scale, which means we're comparing you to what exists in your industry for similar companies in your country.
In the
And
country. Okay.
the asterisk will be replaced by that country's our internal code for that country. So if it's a
Okay.
Trinidad and Tobago national rating, you'll see TTA,
Mm-hmm.
for example. But the Caribbean scale is the
Oh,
equalizer for everyone across the region. So the Caribbean scale
right.
is what sort of you can look at to compare companies, say in Jamaica to one in Trinidad.
Okay. And then you have a positive and negative sign right after the rating,
Right.
the
So
letters.
so Right.
Does
So let
that
me
mean,
explain.
yes, go ahead.
Yeah, let me explain the letters a bit. So you rightly said it
Mhm,
goes from AAA down to D, right?
mhm.
In the credit rating world, we have basically two broad boundaries, right? And you'll hear this terminology. You have investment grade and you have speculative grade.
Right.
Investment grade typically means higher quality, and that the boundary for investment grade is triple B and above. So on that
Okay.
chart, once you see that triple B, anything in that bucket and above will be considered investment grade or higher quality.
Right. Right.
And below that, it's the more speculative or higher risk type rating. So when you get into double B, single Bs, obviously those you could see trending closer to D means that the probability of default gets higher the lower down you go on the scale. And the
Yeah.
probability of default gets lower the higher up you are on that scale.
Yeah.
So, and then the plus and minuses, those are what we call rating modifiers. So it kind of works as building a gradual progression or regression. So if you
Up or
start at a
down,
certain
up or
point,
down the scale.
up or down, yeah.
Hmm.
So for example, in the triple B category, we have three triple B ratings. We'll have triple B minus, triple B without any symbol attached to it, and then triple B plus. So the one without the symbol is sort of the middle ground. So
Right.
what that says is your investment grade. So minus means triple B minus means your investment grade, but you're at the lowest end of the investment
Low
grade because
end.
that's
Right.
that's that's
Hmm.
the bottom of the triple B range. The
Hmm.
one without a symbol would be sort of the middle of the range, and then plus means now you're at the upper end of the triple B range. So your next step, if you get upgraded, means that you'll be going into the A range, right?
Right.
And you may have, and as you know, sometimes when you go up a notch, you may start at the bottom of that new range, or if
Right.
depending on how strong it is, maybe you get a multi-notch upgrade. Those are not very common, but they do happen.
Common. Yeah. Yeah.
Yeah, but that's it's meant to show progression, and it helps also in managing how ratings work in practice with clients as well, which we'll discuss a bit more. So that's how we use those modifiers, what we call the rating modifiers.
So you mentioned earlier some of the challenges you face when, for example, you spoke about if you're rating a company in a particular country, um, and you don't have a formal rating for that country. But if you're rating a company within that country, you have to have at least an internal, informal rating for the country to sort of set the context for the company. And you were mentioning that there are some challenges there. You want to discuss those?
Yeah, so the specific challenge with that is to assess any company, as you rightly said, you must start at the macro level because every
Hmm.
company operates within an environment and we need to understand that environment. So the sovereign sets the overall tone for the environment within the country. So
Hmm.
we have to do a sovereign assessment and assign some sort of internal rating to that
Right.
sovereign. Those are not shared publicly.
Okay.
Then we would assess the industry because different industries have different parameters, different requirements, different nuances, cyclicalities,
Hmm.
etc. So we need to
Hmm.
understand the industry to understand how this company that we're rating fits into that overall picture.
Hmm.
So I would say one of the challenges is, as I mentioned before, governments typically get the international ratings because they raise financing internationally, right? A lot of
Right.
countries have U.S. dollar debt, and all fairness, that they need the S&P and the Moody's and so on for that kind of financing, right? So
Right.
no, that's fine.
Just to,
But
just
what
to
we need,
define for the audience, sorry, just to clarify, S&P meaning Standard and Poor's,
Standard and
rate credit
Poor's,
ratings, Moody's
yeah,
credit
those,
ratings, Fitch credit ratings
right?
for those
So
countries
those are
that want
sort
to
of the
borrow internationally. Yes.
correct. Those are the
Hmm.
big three in the world. They're the big three. So we know, like in the auditing world, we have the big four, like the PwCs, KPMGs, etc. Yeah. So in the ratings world, you have S&P, Moody's, Fitch as the big three.
Right.
So yeah, so one of the challenges that we need governments to understand is that even though you may not need a regional rating because you may not be looking to do your financing within the region or locally, it does create what we call a country ceiling for the local companies.
Mm-hmm.
So that's a principle in ratings that I'll explain. If you operate within a country, naturally the company's rating could never exceed the country's rating because you're subject to whatever goes on in that country,
In that country. Yep.
except if you are diversified and you operate in multi
Across countries.
jurisdictions.
Yes.
Correct.
Mm-hmm. Mm-hmm.
So it's
Mm-hmm.
important, even though you may have an S&P or Moody's rating as a country, most of the companies within a country are not able to either afford it or need it
Mm-hmm.
because they may not be going to the international markets, and they may just need either local or regional financing. And
Mm-hmm.
that's where the CariCRIS rating really makes a difference, where we can rate the country, provide that country ceiling so that when we have to go in and rate the individual companies, we already have that information in hand rather than us
Right.
having to basically estimate it based on public information. Because as part of a rating process, whether it be company or country, we do sit with the people that run either the company or the country. So in a country's case, we will be sitting with your minister of finance, with your central bank officials, even sometimes the opposition
Yeah.
will meet with those representatives
To
because
understand
we
what's really going on.
correct, because as I said,
Mhm.
qualitative aspects also factor into the rating, so we get a sense of
Right.
what the vision and strategy is, and we get a sense of how the country is being managed. And then that gives us more information that we wouldn't normally have from just looking at public information, which is more quantitative. So it's
Right.
important, we feel. So that's one challenge that we face, and that helps us also with data because, as you know, data in the Caribbean is challenging. And when you need to find things like, how do I find the data on the, I don't know, the manufacturing sector in one of the islands, right?
Mm-hmm.
So having access, formal access to the government and to the ministers and so on gives us a bit more ease of access to access some data that they may have that we could use. So that helps us as well. Having these formal relationships actually helps us get data a lot easier. Those are some of the challenges. But the third challenge I'll mention is that one of the things that we've seen is that ratings is not included in regulations in the region in a practical way, right?
Mm.
So in most developed markets, there'll be regulations that says if you are buying assets for a pension fund or if you're buying assets for insurance or whatever portfolio, there are rating requirements attached to that, right? And
Meaning,
that's
for
why that
example, like I remember in particular pension funds that I've had, sort of, involvement with, they will say, okay, we need to have like 40% of our portfolio, we would like it to be invested in this particular currency, say US dollars, in A-rated um, instruments.
yeah, so that's an example. So
Yeah.
what you're mentioning there is there are portfolio targets that will be linked to credit quality, for example. And that's a
And you're
way to
saying
build
that the
diversification,
regulators, right?
right? No,
And you're
that's
saying
not the
the
aspect
regulators, sorry, go ahead.
yeah, let me explain what the regulation
Yeah.
actually does,
Hmm.
right? So
Hmm.
in developed markets, you have, like, for example, to qualify for maybe a pension fund, you will have to have a certain minimum rating to qualify for
Yes.
these funds.
So be included in the
But
fund. Hmm.
right. In banking regulations, the rating of your assets dictate the amount of capital that you hold as a financial institution because the world has moved to risk-based capital requirements. So if
Right.
you're holding highly rated instruments or highly rated companies in your portfolios, chances are your capital requirements are going to be lower than holding lower or unrated assets. And that, what does that do? It gives you more capital to deploy in other things, right? More to lend, more to invest. What we have in the Caribbean is that we have adopted a lot of the Basel requirements, but we never really adapted it to the reality of our region. So,
Mm-hmm.
most of our countries, we're small island states. Most of
Mm-hmm.
our countries are, by international standards, below investment grade, right?
Mm-hmm.
But the regulations is written with the benefits being ascribed mostly to international investment grade or better.
Right.
So, and then the other anomaly is that unrated from the Basel rules carries a lower risk charge than something that is rated below investment grade, for example. Now that works in a market where you have thousands of companies, right? And
Right.
where you have the full spectrum of ratings. If we had to apply that to the Caribbean, most of our companies would fall in that below investment grade category because our countries are just not rated investment grade, right? Save and except maybe
Right.
Trinidad and a couple others.
Cayman.
Um, Cayman, correct. So there are a couple of territories, but by and large, most of the Caribbean is below investment grade. So most of the companies, by international standards, will be below investment grade. And when we apply rules like Basel Wholesale, it means that what we're saying to the market in practical terms is that if you hold a rated asset and it's rated below investment grade on the international scale, you will have a higher capital charge than if that asset was unrated.
Right.
So
So,
that's so you could see where that becomes a practical challenge.
and just to translate that, simply for the audience, I mean, basically, we have an international standard prescribed by Basel that looks at credit ratings and, in particular, investment grade ratings to be treated more favorably. And in the Caribbean, on an international rating scale, not your rating scale, but an international rating scale, many of our countries do not rank as high as investment grade. And what that means is that we are operating in a system that actually sort of punishes us for the fact that, and actually, when you read some of the credit rating analyses coming out of, like we mentioned earlier, the big three, the Standard and Poor's, Moody's, and Fitch, you will see that in their methodology, they identify the smallness of our markets as one of those factors that drives our credit ratings down. And so we are basically being punished for the fact that we're small in the ratings methodology, and we're being asked to adhere to an international standard that doesn't recognize our specific circumstances. So tell us, if is it that CariCRIS then is the one rating agency that does, forget about the international standard, that does actually recognize our smallness, not so much as a challenge as the larger credit rating agencies.
Yeah, correct. And I mentioned before we have our regional scale and national scale, and I mentioned
Yes.
before ratings are relative, right? So
Yes.
we will benchmark our ratings against the best and worst of our region. That's how
Mm-hmm.
our scale will be constructed. So
Mm-hmm.
we're not gonna. So we have good companies in this region. We have strong
Absolutely.
countries in this region, right?
Absolutely.
It's just that we're small, so we can't compare ourselves to these large Central, North American, and European countries where one city might be the population of the entire Caribbean, right?
Exactly. Mm-hmm.
So we CariCRIS goal is to normalize the ratings for the specific circumstances of this region.
Right.
And therefore, what we're doing is we're going to point out to the market who are the higher quality versus lower quality sovereigns or corporates based on our regional analysis and our on-the-ground experience and our regional relativity scale, right?
Good.
So we're not going to, so when we're doing a bank, for example, how would it, how could I assess, who's the largest bank, like the Republics or the NCBs of the region against JP Morgan? You know what I mean? JP
Yes.
Morgan, one state might be our entire banking sector. So, it's not fair to say that, okay, we have companies here that are below international investment grade if we had to compare against the wider world. But in our context, they are investment grade, right? In our
Yeah.
context, they are good quality.
Yeah, because you're basically you're compare if we use the fruit analogy, you're comparing cherries to watermelons, right? So they're two entirely different things. But it's good that you have this sort of mandate to um, basically make the ratings more relevant and the rating scales and the way that you operate more relevant for our size and our types of jurisdictions that we have in the Caribbean. Because really, you cannot compare us. I want to switch the conversation a little bit, and I know that this is something that the rating agencies globally, and I'm sure you are as well, spending a lot more time thinking about in terms of the risks we face with, well, some people say the climate crisis. Some people prefer to use the language of extreme weather events, depending on your political persuasion. Um, we have a situation where we've seen, Grenada, what, 20 years or 20 something years ago, being wiped out and basically not being able to honor its debts and being deemed to be in default because they couldn't pay their debts. We have Hurricane Melissa that, damaged the western part of Jamaica late last year, and that prompted a credit rating event. Tell us about how you think about, look at, and manage for from a ratings perspective these kinds of events in the Caribbean. Because again, if you're looking at making these ratings relevant for us in the region, this is a reality that we really have to wrap our heads around, um, because they're
Yeah.
becoming more frequent and more severe.
Yes. I mean, each situation is different. Now, there's something that in the ratings world we call watch, right? A ratings watch. So typically, when something extreme happens where you're not sure of what the outcome is, because as you rightly said, if a hurricane hits an island, it may take some time for you to realize the full impact of that,
Absolutely.
right? So in many cases, you'd see rating agencies put in countries on watch when there are these big one-off events because they need some time, right? Now,
And
in the
issuing the
case,
watch notification basically says to the market, we're paying attention to this, expect us to say something soon.
correct.
Hmm.
Yeah, watch is not usually something you leave on for a prolonged period of time. Now, watch could be
Right.
positive or negative, right? So let me
Yes.
just not don't want to give the idea that a watch is only negative. But in the
Right.
case of a major hurricane or any other natural disaster or any sort of one-off event that we didn't think about that we think could have broad impact, you'd issue a watch exactly as you said to say to the market, well, look, this situation is developing. We need some time to assess it, but
Right.
just know that we have our eyes on it. Now, in the case of Jamaica, to Jamaica's credit, when Melissa hit, because I think most rating agencies became aware or were aware that Jamaica had these contingency facilities in
Funds.
place,
Yeah.
we
Hmm.
really didn't see any major negative reaction from any of the international agencies,
For
and
the
we don't
first time,
formally,
probably ever, we didn't see a major negative reaction. Yeah.
right? We don't rate the sovereign, but even for us, we do rate companies within Jamaica. So
Hmm.
we would have also issued our own watch to say, we're keeping an eye on our rated entities, and we'll see how things evolve.
Right.
And the truth is, I don't think any rating agency had any negative actions even after after the watch period or assessing it. So it just speaks to you need some time to assess the situation. In this case, the rating agencies probably needed time to see, okay, what's the extent of the contingencies, how much funding could be raised to be directed towards rebuilding. Does it mean that debt is going to spike again, and does that present new risks because debt was trending down in the case of Jamaica?
Of Jamaica,
So
yes.
sometimes you just need to take a period to just assess these things. And once you get the
Mm-hmm.
information, and obviously there'll be interruption too on the ground because of damage and other things. So you just need to give a little time to assess those things. So I think to be fair to credit rating agencies, unless it's something really extreme that you could sense that the impact is very immediate, you tend to be a little more careful in terms of how you just issue, especially downgrades, right? Because that has negative
Yes.
implications. So you want to be
Yes.
very careful. You want to make sure you communicate with the client. If it's a sovereign, you communicate with your ministers and so on, and just make sure that they're aware of what you're thinking, and they will be in a position to provide information to help you understand the situation, so that you don't prematurely downgrade somebody when it might not be necessary, right? So that's
Yeah.
typically how we look at it. We'd use a watch, we'd use a period to say, okay, let's observe what happens, let's gather the information, so that if we act, we know we're doing it from a place of information and consultation as well. Most credit rating agencies will always be talking to the client, whether it's a government or a
Right.
corporate, before taking
Right.
any major action.
Right. I mean, and I interviewed Isaac Anthony, who's the CEO of CRIF and the CEO of Capri, the Caribbean Research Institute, Policy Research Institute in Jamaica, to talk about, when Hurricane Melissa hit and the kinds of financial instruments that Jamaica had available to it when this hurricane hit. And that meant that the government didn't, like you said, didn't have to go and borrow a whole bunch of money to try and support and fund their recovery. They already had these instruments. And I think that these instruments, I feel, and this kind of borrowing where governments borrow where there is a catastrophe clause, let's just say, in the loan agreement, where if there is a catastrophe, I can press pause on my repayments. These are things I would imagine would be supportive of a credit rating being stable even when there's a catastrophe.
Yes, so you're right. When we assess the situation or the country, you will look for contingencies. And contingencies could be different things, right? So it doesn't necessarily have to be a fund that pays out. That's one contingency,
Hmm.
insurance, cat bonds, etc.,
Hmm.
where you get cash. But it could be, as you said, maybe you have clauses built in that gives you a reprieve from having to make certain payments.
Yeah.
Whatever is the contingency, you know, we as a credit rating agency will take those factors into account.
Hmm.
And once we're comfortable that the country that had the event occur is able to maintain their credit profile without serious deterioration, more than likely no action will be taken. Now, conversely, or if there's evidence that suggests, well, look, the impact is just way too much to be handled,
Yeah.
and it will lead to deterioration, it will lead to higher debt, it will lead to other negative things that could impact the overall country performance, then those things could lead to negative outlooks or downgrades eventually once
Right.
the full situation is understood. So, but as I said, the point I want to reinforce is that it's a consultative thing. It's not, we don't act unilaterally. We always consult with the client, whether it be the country or company that's impacted. We always try to get as much information and understand the situation as much as possible, and only then we act. And CariCRIS has a unique structure where we have an independent rating committee, right? Our rating committee consists
Mm.
of individuals who don't work for CariCRIS full time, right? And
Mm.
they have to approve all these actions that we take. So there's even a second pair of eyes. Our internal team will look at the situation and make a recommendation, and then there's this independent body that would review it and determine, okay, this is fair,
Hmm.
or maybe you need to modify it in some way. So that's that. And for CariCRIS, that's it's a two-step process.
Right. That's interesting. I wasn't aware of that. But you talked about negative outlook. So if an event takes place, you're hit by a hurricane. So each rating has an outlook. Explain to us what that means. And because the reason why I want to distinguish it from an outlook on your overall economic performance, which matters in a rating, but it's not the same thing. Because many times we see across the region, you will have a situation where there is a change to the outlook on your credit rating. We've seen it happen many times in Trinidad and Tobago. The outlook for your rating moved from stable to positive, and you will see the politicians say so and so rating agency has said our economy has a positive outlook, when in fact it's the rating that has a positive outlook, which, as you discussed, is a very specific thing and it's an opinion. So, explain to us this thing about the outlook and how that, and what that is and what it isn't.
Well, generally the outlook gives direction, right? So
Hmm.
the outlook is a way of sort of similar to the modifiers. It's another gradual step that we take to ensure that ratings are not just a surprise to anyone, right?
Hmm.
So the outlook is something that gives us the ability to signal to the client and to the market where we think this thing is going to go over the next
Most
12 to
likely.
18 months. Yeah.
Right. Hmm.
And it's over a period as well, right? It's not open-ended. It's like it's
Right.
we when we do the assessment, we would have some thoughts as to how it should look in the near future. So for example, a positive outlook would typically mean things are improving. So they're not
Right.
wrong to say that things are improving, right? Because the positive outlook does suggest that things are improving. And a positive outlook typically means that we would take a positive action, which is an upgrade, within the next 12 to 18
To
months
18
if
months. Hmm.
however, if the parameters that we set are met, right?
Right.
So the positive outlook and obviously on the negative side, it's the opposite, right? There might be some negative thing developing, so we issue the negative outlook as a way to manage just jumping into a downgrade. So it gives the client and the market a sense that, look, this thing is trending in a certain direction, and certain changes might need to be made, or
Right.
a downgrade will happen. All right. So, there's a third outlook that we have called stable. Stable means,
Hmm.
over the next 12 to 18 months, we're not really seeing anything that will either drive it up or down. So it's pretty much going to stay around the
Stay the
same.
same. Hmm.
So
Hmm.
that helps, manage the transition of ratings, um, from one level to another. So the outlook, the modifiers, all these things are built in to give a nice stable, because we don't want things to be chaotic, right? We want things to be very well structured, and we want to give both the client and the market a sense of how this thing is progressing, right?
Right. You were saying that when there is an outlook assigned, let's say in this case, we want to talk about negative. You said that one certain parameter, or even let's say positive, one certain parameters are met, one certain targets or policy actions are taken, then perhaps the rating can move up or down depending on the outlook. So you're trying to say then that when you prepare your ratings report, you basically say to the company or the country, if you do these things, it can lead to an upgrade, or if you do these things, it can lead to a downgrade, or if these things happen, it can lead to an upgrade or a downgrade. So
Yeah.
so you're giving clear parameters and guidelines to the rating, to the country or the company, what are the things that will drive this rating up or down?
Yeah, so yes, in every report we have a section called rating sensitivity factors.
Mm-hmm.
That section comes at the end of the rating report,
Mm-hmm.
and what it does, it says your rating could be upgraded if one or more of these factors are met slash achieved, right? And it could be quantitative things or it could be qualitative things. So improvements in, let's say, debt profile, improvements in your GDP, improvements in your management of the economy from a qualitative standpoint as well.
Mm-hmm.
You know, so we would list things that would lead to the upgrade. We list factors that could lead to a downgrade, and we always clarify it. It could be one or more, right?
Right.
So that's where the rating outlooks become handy. So if we have say five parameters, and we see that the country is hitting three out of five of them, we're gonna say, okay, well, it looks like this, and we when we project out, we see that based on our expectations, it will improve. You may issue a positive outlook at that point, right?
Right.
Now there are the cases where countries do very well, right? So they may hit all the
Yes.
parameters and maybe even more than we expected. And in that case, you may skip an outlook and go straight to an upgrade,
An upgrade
right?
in the
Yeah,
rating.
it can happen. Anything can happen. But typically, you'd see gradual improvements. You would issue a positive outlook, and then eventually, maybe in the next cycle, if things continue as we expected, you get your upgrade. Similar for downgrades, you issue a negative
Yep.
outlook. In the next cycle, you could have the downgrade, or could not, because people could work on the things that were identified and try to prevent them from escalating. And that way, you can have a negative outlook reverted back to stable
If you take
if
corrective
if
action.
you take corrective action, right? So
Right.
again, this is all it's all part of the discussion. It's all consultative. It's all very transparent.
And
Where
transparent, yes.
yeah, where we give these indications so that when actions are taken, it should not come as a surprise.
Right. And that's important because I feel like sometimes the rating agencies get a bad rap, bad reputation, when, of course, it gets politicized when there's a downgrade and they will say, this was unfair or whatever. But in the reality, what you're saying is that even before the downgrade takes place, you have already outlined these are the factors that will make your rating improve, and these are the factors that will make your rating decline. So the governments are aware and they have a choice whether or not to take those actions. And so it's
Yeah,
not a case of you surprising them with a call at five
yeah.
o'clock in the morning that you're going to be downgraded. It shouldn't ever be a surprise.
Yeah,
But
that
how
that's
do
that's
you
a highly
manage
unlikely
that?
situation. That's a highly
Yeah,
unlikely. I mean, if something very untoward happens, even then there's consultation. So it's
of
highly
course.
unlikely that you'll ever get a call 5 o'clock in the morning saying we're going to downgrade you without some
Yes.
information or consultation happening.
How do you
But
manage
yeah,
that though? Yeah. What is that like? Walk us through what that looks like when it has to happen, because I would imagine you have to be careful how you do these things.
yeah, downgrades in particular are the difficult ones, as you could
Yes.
well imagine, right? Nobody's
Yes.
going to fight an upgrade. And the truth is, the only real way to manage downgrades is really through transparency.
Yeah.
And as I mentioned before, it's not an overnight thing. There will be gradual steps that occur.
Mm-hmm.
So, and typically we hardly ever downgrade or even assign a negative outlook if it's just a one-off. If we see a weakening performance and we determine, look, this is just a temporary thing, it's a one-off, it's not going to impact you long term. Even if you
Mm-hmm.
have a bad year, it's not necessarily. going to lead to a negative outlook or downgrade if, when we do the forward looking projections, we determine it's temporary, right? So that's the first thing. And just a bad
Mm-hmm.
year is not necessarily going to lead to a
A
negative
downgrade. Mm-hmm.
implication unless the magnitude is severe and the projection is that it will continue. That's one. Two, as I mentioned before, every year the process will highlight these rating sensitivity factors. And whether it's a corporate or a sovereign, they will be seeing where, if it's a downgrade, where the downgrade factors are being hit. So, for example, for a
Mm.
country, if we say, okay, a downgrade parameter might be debt to GDP going above 80%, as an
Mm-hmm.
example,
Mm-hmm.
you must know if you're above 80%, right? Or if you're going
Mm-hmm.
to likely be above 80% over the next 12 months.
Right.
So, so some of these things will not, should not, I should say, come as a surprise,
Mm-hmm.
because we will outline what those parameters are. Now, maybe there might be disagreements on what the parameter should be.
Should be.
So
Right.
those I could see where that could lead to some discussion and maybe a difference of opinion.
Right.
But the truth is the parameter, once it's noted in the report, it's there for both the
Can't
client to
change.
see
Yeah.
and for the public to see. And you could probably even track back and see, okay, this thing has really been declining over the last couple of years. So if the negative outlook happens, that's a conversation we have.
Yes.
We've pointed out these different parameters that have been trending in a certain way. We've hit three out of our five negative parameters. And therefore, we think, based on our outlook, this is going to continue to worsen. So we will probably assign a negative outlook at that point. All
Right.
right. So, but managing the conversation will always be tricky because there will always be
Yes.
differences of opinion. There might be thoughts that some things are short term and not long term. That's always, not everything is
A debate.
so clear.
Mm-hmm.
Even if something is exceeded, there might be a temporary aspect to it. We will probably err on the side of conservatism, whereas clients may err on the side of optimism sometimes.
Yeah.
So it's a balancing act, right? But the truth is, to have those difficult conversations, we try to ground it in as much fact as possible so that we hope to take the emotions out of it. But no, I will never blame anyone for being, you know, or having concerns or being upset about a downgrade because it impacts you, right? If you're a government,
Absolutely.
it will impact how you access the markets, the cost of funds on new instruments that you issue, and just general negative sentiment.
Sentiment.
So
Yes.
yeah, so
Yes.
so so we could understand why clients would feel the way they would and why they'll try
Yes.
to avoid it. But the
Yes.
best way to deal with it is really to ground it in analytical rigor and as much fact as possible.
Yes. But you're right. I mean, when a rating downgrade takes place, it means that when the government has to borrow, they are likely going to have to pay a higher rate of interest. And maybe some lenders may not want to lend them anymore based on a downgrade. So it does have implications. And so we have to be aware and sensitive about those implications in doing it. And
It's
Derek,
like you mentioned before,
yeah.
just one
Hmm.
thing, as you mentioned
Yes,
before, if let's say they had assets of that government or company in a portfolio and suddenly they don't meet the portfolio requirement anymore,
requirement. Hmm.
that the people are going to
Might
be
have to
selling
sell
their,
it.
their bonds.
Hmm.
And as you know,
Hmm.
when you sell stuff, it means that that could potentially impact the
Push
yield
down the price. Yes.
and push down the
Yes.
price and increase rates for the company or for the government. So
Yes.
it's real world implications. So we know it's important, and I can't stress this enough. We try to make it grounded in as much fact and good and transparency as possible.
And ample warning as
Yeah, and
well.
and the
Because,
gradual
yeah.
progression of the process.
Yeah. So, Derek, I just, to close the conversation, I just wanted to say that I feel like it's important for our viewers to recognize and understand the importance, what a credit rating is, how important it is, and how important it is that you're doing this work to better contextualize credit ratings in a Caribbean context, because we have the big three international credit rating agencies, but they exist in a completely different context. And it's important that we have our own specific nuances being considered in the credit ratings, that in the framework that you have. And so I want to thank you and congratulate you on the work that you and CariCRIS do. And I also want to say thank you as well for spending this hour with me explaining everything that you do to the
Yes.
audience. Mhm.
Happy to happy to participate anytime. I mean, I think we just touched the tip of the iceberg a bit because, as you said, it's an important topic. We are doing our part to try and build education in the region. We're doing our part to engage with government officials and regulators. So we play an active part. We participate in industry groups to
Good.
give our opinions, and credit to the regulators. In most cases, when we ask to be part of these things, we do get the opportunity. So we try to influence that way as well. But sessions like these, I think, really help because if the public is aware and the public knows that they can ask for a report on a government or a company, and more people start to ask for those things as part of their just their education or as part of their investment process, then it will be demanded, and then I guess there will be no choice but for more ratings to exist.
Yes.
And my final point is ratings is really the ultimate end goal is to facilitate a transparent and robust capital market to give both the companies and governments an alternative source of funding rather than having to
Hmm.
go to
To
international
banks.
players or always having to go to banks because even banks
Yeah.
themselves have restrictions once lendings go beyond a certain size. So this gives just more options and more flexibility, and to have a good, robust Caribbean market and to have robust growth, we need to be funding the opportunities that present themselves to our companies and to our government. So our goal is to help support the development of the capital markets as best as possible. And our role is to provide transparency and information, and we will continue to do that work.
Good. And I encourage the audience to go to your website and check it out. I know that you can sign up for the newsletter, which I have, and I get very often in my inbox with lots of good information. So, encouraging everybody to go sign up for that to get a better
And
understanding of what's happening in the world.
and you can also follow us on LinkedIn because we post all the rating updates on LinkedIn together with the brief summary. So if you're on LinkedIn, you'll just see those alerts coming in and you can look at the rating actions that we take. Plus, we write interesting articles
Yes, you do.
and pieces as well. So all of that is there on the website, it's there on our LinkedIn, and we'll give you the information so you could share to your viewers.
Great. Thank you very much, Dereck. Thank you again for joining me, for finding our freedom. I appreciate your time and for sharing your insights with us. Thank you very much.
And thank you for having me, Marla. Thanks again.
Okay. Bye.
Bye.